Let's continue the conversation with our panel, though. Joining us now is Barbara Doran of BD8 Capital Partners and Scott Wren of Wells Fargo Investment Institute. Good afternoon to you both. I mean, stocks took a pause here. This rally took a pause here. Barbara, Bespoke tells me that three-week rallies in the S&P and NASDAQ are the largest since the first half of 2020. Do you take profit here?
Well, I think that for risk management purposes, if you're a portfolio manager, yeah, you start to trim positions a little bit, but not much, because I think this rally could continue. I think some backing and filling, as Mike, to use Mike's words, is normal here after, particularly when you've had in November, NASDAQ up over 10%, S&P up over 8%. But I think the fact that the Fed is pretty much done hiking provides some support and downside protection in this market. And I think the NVIDIA, I think we'll see what happens there. But I think, you asked Mike the question if you think that would affect market psychology, and I think it can, because I think we're in the midst of a major chase here, and that's to get positioned into year end. If you saw last week what happened to Palo Alto, the stock was down 20 points on some misunderstanding or confusion about their billings, but the stock has recovered all. People are racing to get back into good names. So I think NVIDIA is reflective of a psychology that we're experiencing right now. So I think after a little more pause, we could see resume higher.
Yeah, Scott, I mean, the Fed minutes, if there was one takeaway, it's that it continues to lean towards higher for longer. There continues to be caution. There continues to be a data-driven nature to the Fed. But even as we see that today, you're starting to hear the D word tossed around a little bit more, whether it was PPI last week, whether it's been in some of the retail earnings we've gotten so far, and the D word being deflation. Are we entering a deflationary environment in real time here?
Well, Morgan, I think for goods, we've been there in deflation. But the question is services. And so for us, inflation is going to be sticky in terms of services. The message higher for longer, that's not anything different. We don't want to chase this rally from here. The opportunity was a few weeks ago when the market was down near 4,100. So I think pullbacks are good spots to buy. We think the market's going to be higher than where it is now a year from now, but we're definitely not chasing this rally. We think the Fed is going to be higher for longer. We're going to see a volatile market. So for those people who missed the last pullback, we think you're going to get another opportunity at least.
Okay, so we talked a bit about equities. Barbara, how should investors use fixed income here?
Well, I use fixed income really as a supplement or a balance, to my equity portfolios. I mean, right now you can get 5+% on short-term treasuries, so it can be a good balance to a portfolio. But in the long term, if you want to make real wealth, it's really in stocks. And so right now, if people are concerned, as Scott just said, that the rally won't continue, you could shift a little bit money in there sort of as a placeholder, but even that's risky. Market timing is very risky. But for me, it's a supplement to my basic stock portfolios.
Watching the consumer this week and beyond, Scott, how much does the jobs picture influence how much the consumer spends and how healthy this economy looks through the end of the year and maybe even trickle through to market sentiment?
Well, John, I think, if Americans have jobs and money in their pocket, they're going to spend it. And so, we're going to see that until the unemployment rate works its way higher, which we think it will. We all know that credit card balances are really high. And I would argue, and we would argue based on our research, that, only the very top end of the income scale really has cash to spend. The lower, let's call it 80%, they're pretty tapped out, whether it's credit, whether it's cash. So we don't see a lot right there. It's the top end carrying things. And so the Fed would, they're not going to tell you this, but they want the unemployment rate higher because they want less spending in the economy. That's going to help inflation and those kinds of things. But, in the near term, when you've got a sub 4% unemployment rate, when you have Americans with money in their pockets, they're going to spend it.
So, Barbara, where would you be putting money to work right now? What looks compelling in this market, especially given the fact that we have seen this recent rally?
Well, I think that people have been talking about healthcare. Healthcare is cheap. It has defensive and growth qualities. And so that you can look in there. United Healthcare is a name I have liked for a long time. I think the tech tech right here is hard to buy at this particular moment, but I think it's long-term going to continue to outperform. So I think you have to wait for some pullbacks. But I think in the near term, there is a lot of chase going on. And I think you look at small caps, although it can be hard to buy because if you want to buy individual names, you really have to have an expertise there. And so, and also I think you look at the regional banks. That is assuming if you think rates are going to be cut in the first half of next year, which I think there's a growing probability that could happen.